Treasury yields continued to move up on the long end this past week. What could possibly go wrong? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Economic data and news was mostly positive this past week, and Treasury yields continued to move up on the long end. In fact, the yield on the 10-year Treasury hit its highest level since July. This Wall Street Journal article basically summed up the mood on Friday. JP Morgan calls it, the U.S. economy has made a soft landing. So, with that in mind, here are the 3 topics that we'll be covering in today's update video. 1. Why did markets end the week so upbeat? And what should bond buyers watch out for in the coming weeks and months? 2. Which treasuries had the biggest ups this past week, and which ones went down? And 3. What's on the upcoming treasury auction schedule, and where can you find the best opportunities with new issue agencies, corporates, and brokered CDs now? Also, remember that the bond market will be closed this coming Monday for Columbus Day. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Here are the 3 big pieces of bond-related news that impacted the markets last week. First, minutes from the Fed's September FOMC meeting reconfirmed that we're not in a hurry to lower rates stance. So, while the FOMC, the Federal Open Market Committee, seems to have overwhelmingly supported the direction of lowering rates, there appears to be more of a robust debate about how fast these reductions should come, which led many observers to conclude that we should probably expect more gradual rate cuts rather than shock and awe moves. And that ties in nicely with our second piece of news. The latest CPIU data was also mixed enough for some in the market to dial back rate cut expectations a bit. The data basically showed that while headline inflation is moving closer to the Fed's 2% target, core inflation, which excludes more volatile food and energy prices, remains sticky. According to the September report, over the last 12 months, the all items index increased 2.4% before seasonal adjustment. This was lower than the 2.5% year-over-year change from last month. Unchanged producer price numbers for September from the previous month also reinforced a positive inflation outlook overall. But as I mentioned earlier, brewing beneath this positive headline inflation development remains a somewhat more troubling fact that core inflation continues to be persistent. Not only did core inflation not come down in September, it even inched up slightly to 3.3% from 3.2% for August. Third, some of the biggest banks kick-started earnings season with surprisingly positive results, signaling a resilient U.S. economy where consumers continue to spend and borrow. JP Morgan led the pack this earnings season, followed by Wells Fargo. So, if we look at these 3 overall positive big pieces of bond-related news, the Fed not being in a hurry to lower rates, mixed but nonetheless overall slowing inflation, and a resilient U.S. economy, it makes sense that yields on some Treasury maturities moved up last week. As our Diamond NestEgg regulars have heard me say often on this channel, slower, smaller Fed rate cuts at the short end, coupled with stable economic growth, a soft landing situation, could keep rates overall at what I call elevated levels for longer than expected. For the bond buyers in our community, this could even have the effect of pushing rates on the longer end higher in the best case scenario, as we've been seeing in recent weeks already. So, if you're a bond buyer, I'm sure you're thinking, sounds good. What's Jen telling me then to be careful of in the coming weeks and months? Well, here's something else you've also heard me say often on this channel. Bond yields move up and bond yields move down all the time, especially now as the market tries to predict the Fed's next move with the backdrop of more soft landing believers. But data remains a bit mixed and markets can be fickle. In my mind, all we need are a few pieces of bad news or some disappointing data points. Perhaps a weaker jobs report next month, or maybe stickier inflation due to rising oil prices, hurricanes, worker strikes, or possibly worse than expected earnings from some of the banks that are reporting in the next few weeks. And of course, let us not forget about geopolitical conflicts that could drive investors across the globe into the safe haven of treasuries. Any one of these bad data points could push bond yields down again and possibly way down. And that is what bond buyers need to be careful of in the coming weeks and months. Bond yields on the longer end are going through a good season right now, and perhaps they will keep moving into an even better range, but they could also start moving in the opposite direction if any bad news or data points appear. So, for those of you who are waiting for 5% yields on longer dated treasuries before the summer, who then regretted waiting and started stressing out about missing the boat when yields fell in August and early September, and who are now contemplating waiting for 5% yields on treasuries again, this is a friendly reminder that the bond market continues to be volatile. But regardless of whether you're looking at the long end or short end, rates at the time of this taping are still at very attractive levels relative to just a few years ago. So, if you're interested in adding more fixed income to your portfolio, especially on the longer end, my general recommendation continues to be to dollar cost average in regular intervals and amounts that work for your situation. Do not try to time the market. No one has a crystal ball, not even the Fed. And there will be a week or weeks when we do this update when Treasury yields will not be up and up. For now, though, for this past week, Treasury yields were mostly up again. I hope I didn't just jinx things for next week. But in any case, let's move on now to the next section of this video and see which treasuries had the biggest ups and which ones went down. So let's see where we stand at the end of this week in the bond market and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. All T-bill yields were down slightly by a few basis points, with the exception of the 3-month, which stayed unchanged. Maturities 2-year and above were all up though, and even by double-digit basis points for the maturities 10 years and above. And yes, that counts as a significant move for government bonds, in my opinion. In fact, the 10-year T-note crossed 4% again for the first time since July, and it stayed above 4% for the week, based on everything we talked about earlier in this video, a rosier economic mood and outlook. The 20-year and 30-year also continued to trend upwards to July levels on the same basis. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields across all short and medium maturities through the 5-year are still noticeably lower than where they were at the start of the year. But the difference has narrowed this week on everything above 3 months. The 7-year has also re-entered positive territory this week and is now above where it started the year, albeit just by a few basis points. And as I touched upon earlier, the 10-year, 20-year, and 30-year continue to move upwards. And for those of you watching how our yield curve develops, it continues to uninvert. By the most commonly used definition of comparing 2-year yields to 10-year yields, we actually are officially back in the positive yield curve zone, and happened for a few weeks, and that without having an official recession. But as I said before, I don't want to jinx it, so here are just the numbers. As of last Friday, the 2-year Treasury was yielding 3.95%, which was less than the 10-year at 4.08%. However, at the very short and long extremes of the yield curve, we still have an inverted situation where the 1-month Treasury yields 58 basis points more than the 30-year Treasury, 4.97% for the 1-month versus 4.39% for the 30-year. Of course, we'll keep monitoring the developments on this channel. You can also find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what is shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. Other than that, it's pretty quiet on the auction front. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping on Fidelity's platform. For corporate bonds, here's where the highest yielding new issues stand at the moment. And yes, there is still a decent list to choose from. If you're interested in brokered CDs, here's where the highest yielding new issues are currently. Remember that regardless of whether we're talking about agency bonds, corporate bonds, or brokered CDs, currently the higher yielding ones that are a bit further out in terms of maturity are generally callable. But do make sure to check when the first call date is, as some of them might be quite a bit longer than others. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still attractive, then check out this video here on our 2024 bond courses. Or come join our next live sessions. Our next live bond beginners course session will be on Friday, October 18th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be talking about the 20-year T-bond and 5-year TIPS auctions. And our next live YouTube member Q&A will be on Sunday, October 27th at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we'll be talking about the 2, 5, and 7-year T-note auctions. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.